What's up, guys? It's Cash Flow Cart. I'm back with another video. I'm recording this on a Tuesday night. It's been quite the day. I had 2 classes today, and I got a test back in each of my classes. Interestingly enough, I got an A on what I thought was a really hard test, and then on the other test, I got a 70. Which I didn't even really study as much for that other test because, it wasn't major specific. But anyway, you guys probably don't care. Let's get into the video. Today, we're going to be reviewing, misconceptions and commonly asked questions within the dividend investing community. And, this is a community I feel like I've been a part of for a long time. So yeah, let's get into it. First off, I saw this post on Reddit and someone shared their portfolio. They had picked all individual stocks and they showed their allocation, which is obviously a brave thing to do on the internet, to share your portfolio with total strangers. And the top reply on it, no SCHD. This is likely to underperform the S&P 500 in the long run. And this kind of bothered me because, in the dividend investing community as a whole, I've been in dividend investing for 7 years now, or 6 years. And as time has gone on, I've seen it drift so far towards SCHD being some, perfect answer for every investor. And honestly, guys, I want to say that is not necessarily the case. Just like any portfolio or any ETF, SCHD is a basket of stocks, and usually it has around 100 holdings. It's passively managed, meaning it tracks, an underlying index based off certain criteria being met of, stocks in the dividend paying universe. And I guess real briefly, I want to summarize my thoughts on this notion that SCHD has to be like the main holding in your dividend growth portfolio. For me personally, that's just not how I see things, because with SCHD, you are paying an expense ratio. You are getting exposure to stocks that might be, currently trading at an overvaluation relatively to the past. Just with math in mind, you're going to be entering stocks that aren't going to perform very well, that are going to fall out of that underlying index. And again, I think SCHD could be a great ETF for someone who kind of wants to use this dividend investing strategy without actually stock picking. But, it is by no means necessary. And I'm sure I'll release a video at some point all about SCHD. But let's move on. Okay, and this next discussion, I think it's kind of similar to the SCHD question, but this guy said, buy top 30 Dividend Aristocrats. So he's saying basically equally weight your money in the top 30 Dividend Aristocrats. So I guess the top 30 companies with the longest dividend streaks. And guys, this is not going to work well for you. You're going to underperform the markets just because of that immediate broad diversification. You're not being rigorous enough in your screening. Like, to put an individual stock in your portfolio, you should do proper due diligence. You should be patient and look for a good entry. And, not to hate on whoever put this comment, but kind of the same thing here, guys. Over diversification, all that's going to lead to is a lot of underperformers in your portfolio. So, I don't know. I don't know when this dividend investing community became so conservative and kind of got this idea that, you just do the work, you buy dividend stocks, and I don't know. If you're going to stock pick, you really need to put in the time. Understand that you're going to make mistakes. You're going to get in things too early at some points. You're probably going to have to cut losses at some points. I know I have, you know, with multiple dividend picks, but that's part of this game. And trust me when I say sticking to it in the long run and, just building your edge, building your system, it's going to be worth it. It is not as easy as looking up the Dividend Aristocrats and just throwing capital at those guys. So definitely do not get that idea in your head. Moving on. Okay, I saw this one, and this is just another thing. I feel like today I'm kind of ranting a lot, but, I think later on in the video we'll get some more positive feedback. But why not just buy growth stocks and sell fractional shares? And I would say immediately the obvious answer to this one is if you're selling shares out of your portfolio, although if those stocks are growing, the total portfolio value could appreciate, you're losing, you're losing your share of a business on a percentage basis. Okay. So basically you're planning on, you know, just selling out of your portfolio to live in retirement, I guess. And, just with that being said, at that point are you estimating your own lifespan and then, just planning on not leaving any sort of legacy? Again, there's a lot wrong with this strategy in my opinion. And I've seen some economists, I guess, speak out about this, talking about the 4% rule is dead. I don't think it's a strategy that necessarily couldn't work at all. But for me personally, my goals are to outperform the broader market and also create a stream of income that increases year after year. And then I can enjoy the income from dividends without ever having to press sell, in a perfect world. Like I mentioned, there's bound to be mistakes here and there, but in a perfect world, the portfolio, the income from it steps up every year and you don't have to press sell unless it's, some sort of special case. Um, Again, that's my philosophy. Moving on. Oh, what the heck? Income versus growth. I just touched on this a lot, but more specifically, what stuck out to me about this post was, okay, on one hand, you've got income, on one hand, you've got growth, and it's like some sort of binary thing. You pick a side, and I cannot emphasize enough to you guys just how wrong that school of thinking is. Like, you're somehow sacrificing growth by income investing or dividend investing. But, we look at some of the best performing stocks in the past decade. It's been Microsoft. That's a dividend payer. Eli Lilly, there's another one. I guess this is just off the top of my head. These are not recommendations. Domino's Pizza, Home Depot, Lowe's. I mean, you could go on and on with these companies whose growth side has just outperformed the market, but they've also paid a growing dividend. So if you're thinking that you kind of have to make this pick between income or growth and you're somehow sacrificing, upside potential by dividend investing, I'm here to say you are not. Also, that seemed dramatic. Also, a lot of the thing, a lot of we're also going to talk about on this channel being opportunistic, with your capital, finding undervalued plays and trying to build out those positions when they're undervalued. As those stocks come back to kind of more of a fair valuation, that's going to be share price appreciation in itself. So that, just an undervalued stock returning to more of a fair market value, that is growth. Okay. So again, we got to stop we got to stop with this kind of war. I don't know. Maybe I'm overthinking this stuff, but let's move on. Oh, here's a chart I meant to show. This is 5 years of data for VUG, which is essentially a stock market growth ETF. And then I've put, a few dividend payers, which I guess would be income because they pay dividends and they're profitable and they're growing free cash flow. I don't know. I put Microsoft and Lowe's, and you can see that this is not, you're not sacrificing growth potential by investing in dividend stocks by any means. Okay. I mean, you obviously have to be very selective, and it's going to take time to kind of pick and find your niche of what stocks work best for you. But don't go thinking you're not going to get share price appreciation because you're a dividend investor. That's just not the case. Let's move on. Okay, I really like this question, and they said, how much money or what percentage of your portfolio do you keep uninvested to be able to jump on something that's low? And I think this is kind of an ongoing kind of struggle. Every investor kind of finds themselves in at some point. You're like, okay, what if this company I really want to participate in becomes undervalued, and then I don't have the capital to build, more of a meaningful position? Guys, I totally understand that worry. And I can't say I have some perfect answer to that kind of moral dilemma, but I will say this. I'm a 22-year-old, and I personally don't keep too large of a cash position because, if the market falls, I'll be receiving dividends, and I'll also be able to actively earn income that I can contribute to my portfolio. And I should be able to take advantage of opportunities. I would say this: don't try to time the market and sell, a great company that is paying you a stream of income and then try to take cash out of that. You're nine times out of 10, you're going to overdo it. You're going to overtrade. You're going to overmanage your money. And that's all I have to say about that. If you're a little older and nearing retirement, it might make some sense to sort of have a real cash allocation in your account. But for me right now, as I'm earning active income and I'm receiving dividends every month at this point in the game, I don't worry too much about, keeping a ton on the sideline. I hope that answers that. Moving on. Another good question. And I think I may have touched on this before in another video, or maybe I recorded a video, didn't post it. I really don't know. Is it smart of me to split up my monthly savings into 2 dividends and ETFs? So just to address this from kind of a broad perspective and how I like to go about things, I have my biggest portfolio, and the one I've been, I guess, investing in and building and tracking for the longest amount of time. It is my dividend growth portfolio. And for me personally, it doesn't make sense for me to kind of try to trade or invest in other things that don't fit the theme of that portfolio in that portfolio. I'm not saying, just dividend invest. Don't try anything else. Don't try to make money using other strategies. What I am saying is open up another account. All right. Because the minute you start doing too much with one account, it becomes really hard to kind of track the performance of that account. And it's just not good for, I guess, your motivation. You could get discouraged. Or you could also be tempted to sell out of dividend positions and try to do some other strategy. Guys, don't do it. Separate your accounts if you need to. I mean, that's what I do. There's no temptation. I have one goal for my dividend portfolio, and then any other strategy, it gets its own account. That was long-winded, but it's late, so I guess that's a good excuse. Okay, what's your strategy when investing if you want to become wealthy slash have enough assets to not have to work? And I included that screenshot, or I guess I included that question because I saw this video today from Matt Darren, and I had to screenshot this specific part because I was like, he summed up the dividend growth portfolio strategy so well, the goal, and he puts beat the S&P 500 in total return while creating a growing passive income stream. And I kind of tried to say a version of that earlier, but if you guys want to just see it written out in just the most plain language, easy to understand, shout out to this guy, Matt Darren. I've seen a few of his videos. I'm a subscriber of his, and I think he does a great job with stuff like this. Moving on, maybe I'll try to get him to watch this video, but I don't know if that's going to happen. All right. Next up, starting my Roth a couple weeks ago. I don't know how the grammar is on that one, but this guy said starting my Roth. I started my Roth a couple weeks ago. Any input? The goal is $10 a month short term. So what he means here, guys, is he wants to make $10 a month on average off his dividends, off his passive income, his portfolio income. And this is so great because, taking these first steps, setting those milestones for yourself, it's going to be so motivating. It's going to keep you focused. It's going to keep you investing. And I mean, whatever this number is, if you're starting from zero, I think $10 a month in passive income from your dividend portfolio, that's perfect. And then, however long that takes you, then you're thinking your next goal. Okay, maybe now it's, for me, I think I was like $10 a month, check. Now I want to get to $30 a month because that'll be about $1 a day. So whatever sort of goal or I guess mind trick you have to kind of tell yourself that's going to keep you focused on this game is amazing. And trust me when I say it will work. Just goal setting each, whatever it is, each time you reach a goal, stepping it up, it's much easier to set these small milestones than to think right off the bat, okay, how am I going to retire off this? Because it's going to seem pretty daunting when you're starting out. But I mean, that still seems daunting for me. But even at this point, I'm still always thinking about, okay, what's the next multiple of whatever I can get to per month, or what's the total per year? I'm rambling about this, but I wanted to share it because it's a great way of thinking as you build your portfolio. I think this is related. Might have been a reply or something. Yeah, this guy said, finally hit my first target, annual dividend income, $100. That's amazing because that is such a good start. And now the next thing he's going to be thinking is, okay, now I want to get to, 120. That's going to be $10 a month. And then he's going to be thinking, now I want to get to 600. That's going to be $50 a month. And then he's thinking $1,200, $100 a month. And it keeps just snowballing from there. And then, the compounding starts to come into play. The dividend increases start to come into play. Maybe you get older and you can start to earn more active income and you're able to invest more. This is amazing. if you have not started your dividend portfolio because you're intimidated, by starting out, start it now. Well, what am I even saying? But this is a great screenshot. What is going on? I put this one here. Someone asked, what are your favorite dividend stocks / ETFs that pay out mid-month? And I understand this line of thinking that you kind of want to sprinkle your passive income throughout the month, not only wanting it to be smooth month to month, but wanting it to be, smooth, I guess, intra-month. And I will say this should not be some sort of criteria for picking an investment when they pay their dividend, what day or what date, because that could essentially cloud your vision. Okay. With all that being said, I do understand the draw to, like, I don't know if it's ADHD, not saying I have ADHD, but I do understand the draw to, like, wanting smooth income week to week, month to month. I get that. I think about that stuff myself, but this could be a discussion, but don't use that as some sort of preliminary screen. This one I liked. I like this question. Anyone else sad to see the recent market rally? And I don't know if sad was the word for me, but we saw the market dip like pretty hard, and I'm talking like end of October. Yeah, through like the end of October, we saw like a pretty hard sell off in the market. I could pull up the charts, but this video is already going pretty long. And now in November, I guess we've seen like that dip seems so short lived. And I'll say this: I don't think I'm sad. I mean, when I have capital to invest, I'm finding my best opportunities, and if it's 5%, if I have to enter a stock 5% higher than what the price was a week ago, but I'm not really upset about that. And if the market continues to roll over and this kind of rally just is a short-lived thing, or you want to call it a dead cat bounce, listen, I'm not going to try to forecast what the market's going to do on a weekly basis. I don't even know why I'm going so deep into this question, but the point is, when you have capital, pick your best opportunities, undervalued stocks that have a wide economic moat, that have increased their dividend year over year, and that is the dividend is supported by free cash flow. In the grand scheme of things, if your fills on these stocks are a couple bucks one way or the other, you're going to be all right. Moving on. This one, I don't know. This made me laugh because it's like, it seems like he's really very serious about like taking advice from whatever responses he gets. So I guess that was a little funny, but he said, not much savings, looking for advice for which dividend stock to drop 300 in a week for the next 10 years. And, what is that? 300 a week. Oh my gosh. Just trying to type, guys. My mic's in the way. 300 a week for the next 10 years. That's $156,000 of capital invested. And it's like, he wants one stock. No matter what happens over the next 10 years, that's the stock, I guess. So if I was going to try to answer this, basically like with some set and forget type of company that I'd be comfortable buying for the next 10 years, obviously you're going to need a company with a wide moat, free cash flow that's growing, net income on the right trend. I would say the stock I'd probably pick would be Coke, KO. Not that I'm going to do this by any means, but if I had to answer this question, I'd go with Coke. That's not it's not financial advice, but I guess that's my best answer. All right. Next question. Why shouldn't I go all in on Jeppy? And I'm not just going to be on here to plug another one of my videos, but seeing as how long this video is already going, I'm going to plug another one of my videos. My first video on the channel is all about, I guess, answering this question about the misconceptions of Jeppy and Tesla or TSLY, and really just this covered call ETF theme. So if you want the answer to this, I have posted a video on it. It's my first video on my channel. Here's another one about a covered call we're going to skip over. I already kind of ranted about all these tickers. All right. So apparently Kramer on Mad Money claimed that Realty Income is a buy, and Realty Income, for full disclosure, it is a position I'm in, and I'm sure a lot of you guys are in it too. And unless you've been in it for a lot longer than me, you're definitely down on the position. It's kind of bittersweet for me because my cost basis on Realty Income is not the best. And normally that wouldn't bother me because if my cost basis was higher than the share price, I would usually average down more into things, and I'd average down more aggressively. But for two reasons, with how big my position in Realty Income already is, it's like I've already thrown enough capital at it. I don't really want to build it bigger, although the new share prices are tempting. And then with that being said, there's also other opportunities. So it's like, do I want to keep overweighting this just because my cost basis is high? I don't know. We'll have to stay tuned. We'll have to wait and see. But moving on. Or is that everything? That is everything. All right, guys. Thank you for joining me in today's video. Like I said, it's Tuesday night. I'm pretty tired. Hope you couldn't tell. But yeah, if you're new to my channel, I'll be posting new content about dividend investing on Monday nights and Thursday nights. It's a 2-video a week schedule I'm going to be sticking to. If you're supporting this channel in any way, whether it's watching this video or subscribing, that means a ton to me because this channel is very young and it's been very fun. I love any support. Thank you guys for tuning in, and have a great rest of your nights.